Hello everyone. Welcome to Chapter 4. We're going to talk about Adjusted Gross Income, AGI for short, this chapter, and understand a little bit more about how it is calculated. So we'll get right into our discussion using these PowerPoint slides. So the definition of AGI is really a subtotal on our way to taxable income. We talked about our tax equation earlier in chapter 1 and 2, and the concept of AGI was brought up as important because certain deductions are for AGI and certain ones, other deductions, are from AGI. First thing you need to understand is deductions are only deductible. You can only reduce your taxable income with a deduction if it is allowed in the tax code or associated rules. So there is no just assumed deduction. Everything has to be actually stated. Unlike the income side that we talked about in Chapter 3, where everything is included unless specifically excluded, nothing is deductible unless specifically allowed. And so a good thing to look at is this is Schedule 1. This is the additional income. We're going to skip that part right now. We'll talk about this Part 2. These are the items that can be deducted for AGI. These are the things that the tax law allows as deductions to get to AGI. Remember, AGI is going to be used, and we'll even see that in our discussion today, is used to determine how much is deductible for other deductions. So it's very important, to remember that some of these deductions are more valuable than others. So a deduction that is for AGI is more valuable than one that is from AGI, because if you can reduce your AGI, you will increase your ability to deduct other things as well. And so we'll see that as we go through this situation. So here's the listing of those things that are deductible. So let's look at some of them in some detail here. Student loan interest. None of us are going to face this issue when we finish up school and paying for our loans on the money we borrowed. So the deduction is limited, first of all, to $2,500. So it doesn't matter how much you pay, the maximum you can deduct is $2,500. And of course, here's what it means to be an education loan. It doesn't necessarily have to be a student loan. It just has to be used solely to pay qualified education expenses. So if it's not a typical loan scenario, federal loan, then you probably better keep some documentation of what you spent the money for to make sure that it isn't going to get scrutinized and disallowed. And there's the definition of what qualified expenses. Notice this pretty broad: equipment, room, board, transportation, and other necessary expenses of attendance. So it's a pretty broad definition of what's necessary. So not have to worry too much about it being just for tuition, that sort of thing. And it has to be for at least half of the normal full-time workload. So it can't be just a class here and a class there. It can be undergraduate or graduate. It's no limit on what level of the schooling is. Now, it's also going to be limited if you're AGI. So here's our example of how AGI is not only affects one thing, it affects other things. This is a situation where if your modified adjusted gross income, and obviously without considering the student loan interest, is your AGI $140,000, then you can deduct the $2,500, and it phases out gradually up until you get to $170,000. And you can see the numbers for the single return as well. So we have a joint return and a single return, not allowed for those filing separately, married filing separately. Formula to figure out how much is not allowed. Notice we're calculating here the amount that's disallowed. We take the amount that you paid up to $2,500 times this fraction. So notice that we take our modified AGI, we subtract the 140, so we're over the 140,000, okay? But when we divide it by 30,000, so at 170,000, then this would be 30,000 divided by 30,000. All of it would be disallowed. So at 170,000, married filing jointly, you get no deduction. But less than that, if it's between 140 and 170, then you're going to take the modified, you're going to subtract the 140, take the difference, divide by 30, and that's going to be the fraction of the interest that is disallowed. You'll be able to deduct the remaining amount. So remember that when you're doing the calculation, you're calculating how much you can't use, and then you'll be able to put on the return the part that you can use. All right, so another one listed on this Schedule 1 of the 1040 HSA. This is an account where you can put money in to use for medical expenses, and the deduction comes when you put the money in, you make contributions to your HSA. And it's for AGI. There's several things that have to be in place for this to be deductible, and you qualify for this. You have to work for an employer who provides a high deductible plan, or no health coverage, and you've purchased your own high deductible. So you have to have a health insurance plan. It's not to take the place of a health insurance plan. It's a savings vehicle for you to save the amount of money you need to cover your deductibles in this high deductible health plan. Okay, can't have other health insurance too. So it's not like for a second plan or an additional plan. This is for your only plan situation. And notice that the deductibles have to fit this, and the maximum you can put in that's deductible is over here. That will be reduced by the amount if your employer makes any contributions. So if your employer puts money into your HSA, that takes away from what you could deduct. So if they put in $1,000, you would only be able to put in $57.50 and deduct it. All right. This is also the maximum out-of-pocket expense on the plan that you have for your high deductible plan. So when clients talking about this, they need to make sure that they have discussed with their insurance broker a high deductible health plan that qualifies for an HSA. The information about how much you put in or withdraw goes on the form 8889, and that is filed with your 1040. So as long as you fit all of that, you get this forward deduction, and then when you take money out, is tax free. It doesn't count as income. You still report it, and it's still reported on this 8889, but you report that you spend it on health costs, and then it's not actually included in your income. So a little bit about how the trustee, somebody has to supervise it. You can't just have it in a regular account. You can't just put it under your mattress. It has to be done by a the legal trustee. All right, this next one is moving expenses. It used to be prior to 2018 that everybody got an opportunity to deduct for AGI moving expenses. That went away, and now is only available for those in the military. Notice they have to be on active duty, permanent change of station, some of the requirements. They would not include any of the allowance that they provide unless it is more than the expenses that they incur. So basically the idea is you're going to get reimbursed in the military most of the costs of moving anyway, but if there's anything that is not reimbursed, the basic idea in the tax law is you get a deduction only if you're not going to get reimbursed for an expense. So that's a good principle to remember about any of the deductions we talk about. This is just one that's particularly obvious on. Okay, so here are the expenses that count. 20 cents per mile, moving expense, get everybody and your stuff there, and also the ability to store it once you get there in case things aren't ready to move right in, that sort of thing. All right. Not meals, that's the key, okay? For no meals on moving. If you drive your car or drive a U-Haul or something like that, and you could have multiple car expenses, meaning the family could come in a car, somebody else could drive the U-Haul, okay? Now the U-Haul gas would be an expense that you could deduct. Then the car, you could either use the out-of-pocket expenses you spend along the way, or you can just count up the miles and multiply by 20 cents, which is a lot easier. However, either way, you get to take parking and tolls on top of it. So if you go on the Turnpike 76, the tolls are in addition to whatever one you use. Okay, you don't get to drive on it for lots of vacation. You got to take the mileage from the most direct route to your new home. Foreign moves have a little different, some rules. All right, so self-employment tax. We will talk about this in more detail in Chapter 6 as to how it's calculated for self-employed individuals. These people that have their own business. Usually the net earnings of the business are what's your self-employment earnings. And you calculate that amount on Form SE and come back and do that, some examples of that in Chapter 6. But for now, I want you to know that you can deduct half of that, all right, for AGI. So half of your self-employment tax. So basically, it ends up being the 7.65% of your net income on the business, similar to the employer, your employer who matches the withholding they take out of your check for Social Security. They match that. They get to deduct that. So in this case, you get to deduct that because you are the employer, because you are self-employed. You're the employee and the employer. All right, so we're going to stop there for this first part of our discussion. Come back and part 2, get into a couple of other of our deductions and in terms of for AGI.